Hi there, welcome to FMCG by Alex. My name is Alex, and today I would like to talk to you about traditional trade distribution. So, for those of you who live in Europe or the US, you will probably wonder what is traditional trade distribution. If you go on holiday to Asia or maybe an African country or South America, you have quite a lot of unorganized retail. So, these are small mom and pop stores basically that not with a cash register, but they still take cash. They have like maybe inside of their house they have a store or a roadside stall that is considered traditional trade. If you look at the numbers in various countries, let's say a country like India maybe has still like 70-80% of the entire country is traditional trade, same as in Indonesia. So these are, like say, hundreds of millions of people who are still relying on these traditional trade or general trade stores, as they are also called. Food provisions come from those stores for these people. So you have modern trade in all those countries, which is like supermarkets, hypermarkets, mini markets, so anything with a cash register. So it's looks a bit like a supermarket, like you would expect it to be in Europe or the US. Traditional trade is the by far the largest channel. Just to give you an impression, if you look at a country like Indonesia, for example, they have maybe somewhere between 45,000 and 50,000 supermarkets, really modern supermarkets, while the traditional trade is estimated to be at somewhere between 2.5 and 5 million outlets. So it's massive. Of course, these are smaller outlets with a smaller basket size. The weighted distribution is smaller, of course, per outlet, but still the quantity is massive. And some companies in Indonesia rely very heavily on traditional trade. So my first employer in Indonesia, Ultramilk, so Ultrajaya Milk Industry, they were 70 to 80% of their sales came from that channel, and today it's still the same. Then, just to distinguish, there is also Horeca, which is hotel, restaurant, cafe, and catering, basically. So anything that is a restaurant or any place where you can sit and eat food, yeah, that is not considered traditional trade, but more Horeca. So just to help you distinguish. Now, some markets are 100% modern trade. So, like I said, Europe and the US are very much supermarket, hypermarket type of mini market type of countries, type of areas, basically. So you might not know the potential of traditional. I think it's disorganized. Sometimes also the outlets don't look like much. Yeah, like they have maybe a bit of rundown interior. Maybe you think, oh, who is going to buy here? But you will be astonished sometimes when how massive the sales can be in some of these outlets, like wholesalers and retailers in this case. So it's fragmented and not organized. So you're looking at a massive number, but they don't have like a brand on their window. There are, of course, several distributors and wholesalers that are trying to organize some of these more potential outlets, basically into groups, buying groups. But yeah, frankly, tomorrow they can start one, and the day after they can stop trading already. So it's also very much a matter of is it permanent or not? Yeah. So in the end, it's the number will be quite stable, but the store that was there last week might not be there next month. So that is basically what I'm trying to say here. So I hear you think at this moment, oh, that's great. I can export my products, and these traditional trade stores, due to their massive quantity of outlets, they can take care of the rest. They can take care of the distribution. Reality is that there is a maximum price point. So if you look at a country like Indonesia, it's about 6,000-7,000 rupiah, which comes down to 35 to 40 cents, euro or dollar cents, basically, depending on the exchange rate, where you have a maximum what you can sell the product to consumers. This is the selling price in the store, so not to the store. You need to be able to sell, much lower than that, of course, to get into the store, and also the distributor needs to make some money. So the relatively small basket size of the stores makes it also an expensive channel for distribution. So you have, in essence, people who are taking maybe a carton of product or a half a carton of product, or even per piece. So depending a little bit on the roadside stall. So you have classifications. You have retail, and then you have something called R1, R2, R3 outlets. So R1 is still roadside outlets, R2 is more like a back alley, and R3 are really non-permanent retail stands, where normally you would basically expect to find cigarettes, maybe some coffee, but that's it basically. Yeah? Ready to drink coffee, like in a sachet, 3-in-1, that sort of thing. Um, Another key point to observe is that this channel can come with some downsides, which is managing returns and bad debt. So bad debt is normally on the side of the distributor, but the problem is with regards to this is, like, if you look at um, two things. So the sanitary conditions might not always be optimal in the market. It's tropical countries, a lot of mice, rats, basically, that are gnawing at certain products. Not every product is affected by it, but there's quite a lot of examples where, for example, when I was selling milk, that rats were actually chewing the boxes and the cartons of milk. We UHT milk in Tetra Pak cartons, basically. So that's the problem that you will face with selling products in traditional trades. If it's longer in the store, so let's say you load up larger quantities, so wholesalers had a more bigger problem than the smaller outlets, because um, smaller outlets, it's quicker turnaround with regards to selling. Quantities are smaller, so the more products are actually stacked in a large wholesaler, the more problems you will have with that. Expiry date, of course, also is a thing, but mostly it was damaged due to rodents, rat bites, basically. Now, bad debt also comes down to it. Like I said, sometimes these outlets have a non-permanent or semi-permanent nature. So you have, in essence, people who go out of business or they disappear. That's credit facilities extended by the distributor or by yourself if you are distributing directly. That can lead to bad debt, and that's something you have to calculate into your margins, basically. So, like I said, the key to servicing this channel is finding the right distributor. So you have to imagine, how do you select the distributor? You have to imagine one salesperson can do about 250 stores per month. So you're looking at a 2-week cycle where they are repeating the same 250 stores in the second week. It's a number of stores per day. Some do more, some do less, depending a little bit on the channel, how the amount of time they are spending in the store, and whether they also need to do the merchandising or not. Yeah, the merchandising meaning like putting the product on the shelf. It's purely selling, so they're not even delivering or anything like that. Yeah, then this is more or less the average. Like I said, some companies have a higher, some have a lower one. Then you should limit the territory of the distributor to what they can handle. So let's say one salesperson is 250 stores per month. Now, if you know that a city that they are covering is having, let's say, 2,000 outlets, and they only have 2 salespeople, then that's a good indication that you need another distributor to cover another part of the city, basically. So that's the idea of this this rule of thumb. So also the channels, obviously, which channel are they strong at? So if you need someone to do both the modern trade and the traditional trade, as well as the HoReCa, for example, now then, are these guys going there? Do they have products that are complementary? What else do they distribute? So complementary products are very important. Mainly, is it something that is not competing with you, and does it actually mix? If you have products that are very good together with regards to the mixing the range of products that you have, um, then it can actually work. If you have products that are totally not complementary, so let's say they do non-food, they do detergent, and then you have coffee for yourself, for example, that you would like to them to distribute, yeah, then that might not be a very good combination with salespeople, because they might go to different outlets, they might talk to different buyers, they different character, plus maybe the product knowledge is difficult to combine, basically. Um, then financial strength and chemistry. So make sure that the distributor also is able to grow with you. So in essence, this is usually a no-brainer. But there are, of course, people who start with the distribution company. It's quite intensive with regards to money. They will maybe ask for extended credit terms. They may be, at some point, if your product is not moving, they might also withhold payment from you, just like the outlet will withhold payment from the distributor. You have to imagine traditional trade outlets have the tendency to accumulate cash, so cash money, because traditional trade also very traditional payment. So let's say the salesman really needs to collect, or the collector needs to collect on, let's say, Thursday. If you come on Wednesday or you come on Friday, the guy doesn't have any money to pay you, because on Thursday he pays all of his suppliers. If you come too late or too early, there will not be any money to pay you. Therefore, you have to wait till next week in order to get paid for all the sales that were made. So this can be a mismatch with regards to trying to find out and managing the cash flow, basically. But point is also that the distributor, of course, if there is a lot of product stuck in the market, meaning your product is not moving without support, you don't give the support to do it, basically, then they also will have a lot of money standing out in the market. Now, it's in essence, you have to imagine that the margin that you're giving the distributor cannot cover that. So, they cannot take an exorbitant risk to, finance your entire working capital with that. So that's one of the things you need to keep in mind. Larger companies, of course, have the advantage of financial strength, but bigger is not always better. So a national distributor will have perfect cash flow, but they will not have focus really on expanding the market for you. You have to really find a chemistry also, like I said, with the owner of the company or the senior management, and also some of the people inside the operations, where it's sometimes better to work with a smaller guy who is covering only part of the area for you. This is, my experience so far has been that these guys are still very hungry and can also manage it. If you have a very large national distributor, then the cash flow is very good. So they have a lot of SOPs in place, standard operating procedures, to ensure that they get paid and that you get paid, basically. So that's very important as well. But it can be challenging for them to shift that focus to expanding the market for you. So larger distributors usually, we always said that a distributor cannot be good everywhere. So that is the main issue with regards to this, where, it's nice to have a one-stop shop, a one door to get national distribution, but still, you will have to go to each of the individual branch offices of this distributor to make sure they actually do what you agree on head office level. So, uh, can be a challenge. You need still to have a team. It's actually the same as managing, maybe 25 or 30 smaller guys than one big guy with 30 branches. These branches still need to be treated like individual distributors. It's just that, financially, it might have a benefit for, having the large distributor, the national distributor, to do it. And of course, for modern trade, if you have chain stores that have, a national presence, then the individual branches, it's easier to do it with one distributor. So in the end, modern trade always is a better choice to have it with the national distributor. If you're looking at traditional trade, national distributors usually are not specialized in that. So having said that, there are always exceptions, but um, it's hard work. I think that is maybe the core of it, the hard work. So the dirty work nobody wants to do. They all want to have the benefits, which is easy, dropping a lot of stock at a modern trade outlet. And the traditional trade is a lot of risk, a lot of payment problems, a lot of hard work. It's just that if you invest a lot of the hard work, you can actually also reap the benefits. Now, then there is a margin strategy. So you need to have a margin of somewhere between 15-25% for the retailer. You need maybe, depending on how big you are as a principal, you can get away with anywhere between 8 and 15% to the distributor. So smaller companies pay more margin because their products are not moving faster. So if you have a fast moving product, you can squeeze the margin a bit. If your product is not or new or not fast moving yet, you need to give a bit more margin because that's when the distributor is not converting it to cash as quickly as a fast moving product. So fast moving products are quite good if you have distributors that can sell cash, for example, to the outlets. Some traditional trade outlets are also cash. The advantage of traditional trade outlets with regards to cash flow is quite an interesting one, because you either you have cash, or if it's a very fast moving and well-known product, they have some, call it canvas sales basically, so you're selling cash to them. Otherwise it's a 7, 14, or maximum maybe 30-day payment terms, but mostly it's 7 to 14 days basically. While modern trade starts at 30 days and it can go up to 60, 90, or even 120 days, and all sorts of tricks for modern trade also to extend this payment cycle. While if you sell to 1,000 small traditional trade outlets and there are maybe 10 that are not paying on time, yeah, you have still 990 left. If you sell to one large retail chain in the modern trade and they don't pay, yeah, then you have nothing. So that is actually a bigger problem. That's why I always advocate for, if you can create SKUs for your traditional trade channel, to hedge it. So to have both a modern trade component and a traditional trade component where both of these actually augment each other, and you have distributors that can cover both. So either two distributors with a specialist, or one distributor that can do everything, meaning you give them the nice stuff, which is the modern trade. It's the easier, lower resource intensive business, but still they need to bridge the payment terms. And yeah, you also let them do the traditional. So you give them some meat and you give them some bone, basically. Then it's very important to determine whether you give exclusivity by area, by product, or by channel. So I have worked in companies that did the area exclusivity, which in my opinion still works the best, because you can really look at an area without having to talk to multiple distributors about developing it. I've also worked with companies that actually did it by channel, sometimes also even by product. So by product that we had, okay, this company is going wild with one product. The main problem with the product and channel approach is that, it's fragmented. So you're talking to multiple people. If you reach a certain size, this might make sense, where you are, you don't have a choice. Maybe if you can't find someone who can do all the channels, then you have to split it by channel. But to create enough business size to be important for a distributor, it's important to also combine these channels. So if you are a small principal, so meaning like your contribution of sales is small to a distributor, you will not be very high on their priority list. If you are looking at, say, larger principals, let's say Coca-Cola, Unilever, they will split distributors. Nestle does the same thing. So have a couple of friends who used to be Nestle distributors for certain areas, and they say, okay, my area got split because I couldn't keep up with the growth anymore. It's not their fault, but actually Nestle decided then to split the area because they felt another distributor with fresh cash flow basically could invest in the growth of the area. And they also want to avoid that distributors are becoming too powerful. You have massive distributors that are developing it. So again, my very first employer in Indonesia had another strategy. So they were starting maybe in the early 70s with distributors. So they have multiple generations for family companies. It's more of a family approach. So they were actually allowing all of their distributors to grow without any bounds in their area. So The big ones are also really big, so they are really massive distribution companies, mainly powered by Ultra Jaya's product portfolio. While even larger principals that they're also carrying, maybe they are not doing the same geographic areas for those companies. So interesting thing is that that works also quite well. So these distributors have a lot of loyalty towards Ultra Jaya, basically in this case. So I have to say, it differs very much by country. I've spent a lot of time in Asia. Asia has a lot of loyalty towards between distributors and principals. It's more a relationship focused market. Of course, it goes everywhere in the world where relationship is important, but I've found in Europe and the US to be a little bit more important what is the content rather than the context. So distributors in Asia will sometimes still continue, even though it might not be as profitable for them. It might be more profitable for them to go with the competitor. They are still loyal because they feel like I can't, I lose face if I actually give up, or I lose this principle, or there is a lot of speculation going on in the market. Okay, why is this guy no longer distributing this brand anymore? So that's less important, I guess, in Europe. It's more of a okay, doesn't make sense financially, then we don't do it anymore. That's basically the purpose. In Asia, also, you have to imagine though that principals will always take good care of their distributors as well because of this relationship. So it's a two-way thing where maybe for the principal it might also be better sometimes to split the area or find another distributor. So I've learned a lot in that sense during my time at Ultra Jaya, how to build these relationships, and that relationships are very much key in this process. So for traditional trade, like I said, nobody likes to do it. There are a lot of companies that actually do it quite well. There are also large companies that actually don't do it very well. So just to give you an impression, do your research well before you do this. And like I said, my best experience so far has been by area, but you don't always have the choice. Then you really need to support the distributor. So if you don't support it and you don't manage it, so basically, okay, here you go, this is containers of my product, and go and sell, go forth and sell. And you don't support these guys with promotions. You don't support them with a bad stock allowance, or you handle the returns. You look at it really case by case, and once in a while it also makes a big impact to actually just go once in a while, go there, look at the market, shake the hand of the distributor, the owner of the distributor, or the local branch manager if it's a national distributor. That is proper management. Have someone look at the numbers on a day-to-day basis. Look at what do they need. Where are we? Are we far off target? Do we need to have more support injected into this branch or this distributor? So these are all very important factors for success. If you just set and forget, that is not something you can do with distribution. And the funny thing is that most of my clients actually, when they come to me with a problem like, oh, my distributor is not performing, or I'm not selling much, or my brand is not, so okay, the key really is mostly in the distributor. So in the end, how you deal with this distributor. So if you have never gone out and cared to look what they were doing or how they were selling your product, can you blame them for not doing it the way you had imagined? So that is basically what I'm trying to say here. And I think this is what I really believe is making the difference in the success or failure of a fast-moving consumer goods brand. Thank you for watching. Please feel free to send me an email at alex@devriessalesconsultancy.com. Please don't forget to like and subscribe if you liked what you saw, and I hope to see you in the next video. Thank you. Bye-bye.